All right, good evening, everybody, and welcome to tonight's webinar. And for you, you're all traders of Legacy FX. So today's webinar is an analysis on how to plot your trades. So basically what we're going to discuss are a few different topics, kind of like skim them. But before we get to any of that, please take a moment to read the risk disclaimer as always. Yeah, it should be long enough. All right. So what are we going to discuss? Well, I'll introduce myself a little bit so you have an idea who's talking, what I do. Then we're going to look at technical analysis, so actually drawing up your charts. Then we're going to look at finding entry and exit levels and some micromanagement levels. So where do you make certain decisions along the way? And then the fourth step is we're going to estimate, basically based on all this analysis, how is this trade going to develop? How long is it roughly going to take? And it depends obviously on your time frame that you're trading in, but the way that you do it basically applies to whatever time frame you're trading. And at the end, for those that are not on the recording, so if you're watching this on YouTube, you won't have the last part, which is the Q&A. That is for the live webinar. All right. Moving on. So about me, who am I? Well, my name is Mike Rotting. I'm Dutch. I live in Greece. And I've been trading for a little over 15 years in the retail forex. I studied international business studies, a Cambridge program in Delft College in the Netherlands. During this time, I found myself stumbling into a hobby that is now known as forex. Now, like most of you, the start wasn't that amazing. Far from it, actually. Like most, especially when I was younger, thinking about how do you get money fast, how do you flip very little into a lot. And after 2 or 3 accounts, I realized that all these so-called gurus and look at how much money I made this day with this technique and how to do this. It just doesn't work. So what I did is threw everything I thought I knew out the window. Decided to really sit down and learn every aspect of the trading, one step at a time, which was a meticulous, boring process, but it ended up and eventually in that account becoming consistently profitable on a yearly basis. And then you fast forward that 10 years where I reached my goal, was able to take that, build up capital out, and put it into other things that I was looking at, which brings me to what do I do? So for the last 6 years now, I've been doing these webinars. This is a part of me that wants to try and share as much of the knowledge that I've built up that seemed to have worked for me to pass on to you guys to hopefully help you avoid some of the walls that I ran into, or fill in some blanks that you might be questioning, or just try to help you guys out any way I can. Obviously, that ties in with mentorship. I do that too. Then, as I said, once you reach your goal, you rotate out into other things. Those other things I wanted to understand them better, which is offshore investments and structured notes and that type of investment levels. So I started studying CSI level 1, which is basically financial advisory. That's an ongoing process. That's an on and off. I do that for myself just to get a good understanding of it. But mainly I am obviously more like freelance, actually hired in for other projects. They're usually investment related, either funding or strategy or mostly financial related or growth hacking related, something like that. Something with numbers, generally speaking, because that's where I had a knack for. And that is me in a nutshell. Sorry. All right, so drawing up your charts. All right, so the first thing you do before you start drawing up your charts is looking at what markets are in right positions, right locations. Now, let me note this. This doesn't matter if it is majors, minors, exotics, commodities, indexes, stock, it doesn't matter, right? And with stock, I mean CFDs in our case. What we're looking for is when things are in a high point in a downtrend and at a low point in a buy trend. Now, there are exceptions to this because it depends on your capital. So I'm going to show you this in a chart in a minute. But let me just explain. When you have a smaller account, so anything up to 2,000 euros or dollars or pounds or whatever you trade in, You should focus on just trading where it is in the optimal situation, which means a lot of time you have to build up the patience to wait for these things to get there. Don't trade halfway in bigger trends. Don't try to make 5 minute trades happen. You try to look for consistency, which is the bigger swings, the bigger movements that are more repetitive and stable, and you try to find the entry points for them at the best possible point that you can get them, that you're okay with pulling the trigger. And I'm going to show you how to do that. And then you take them. So generally speaking, if something has been in a downtrend for 2 or 3 months, then most likely it will still continue doing the downtrend unless there's a fundamental driver reason for it to change direction, or it's at an extremely low price point or an extremely high price point based on history. But obviously that comes in with other arguments like inflation that shifts the market prices. Forget about that for now. What is important is, like, if you see an uptrend and you're in the bottom of an uptrend, then that would be the most optimal time to go in, because the probability of it just following the trend is much higher than it going through. Now, I know that you're somebody thinking, yeah, but it breaks trend lines all the time. True. But if you think about how many times it respects it before it does that, if you take every single one of them, most cases you will make 4 or 5 big trades before you lose that fifth or sixth one. And with these big probabilities of them just doing what they should be doing with a proper risk management, again, we're going to cover all of this. You will see that you will significantly increase the growth of your account with less risk that you're taking along the way, right? No more, I'm halfway in a channel, it looks like a buy, so I'm going to take a buy. My stop loss is somewhere in the middle of the channel for some reason. All these kind of things because I'm trying to make my ratios work, right? We're going to look at that. But the first thing we need to do is find a market. So the easy way to do that, it's very simple, is you just pick the charts that you're on. Now, if you have a smaller account, like I said, right, so up to $2,000, right, stick with the majors and the minors. I know a lot of you want to trade indexes, a lot of you want to trade commodities like oil and gold. The problem is, if you try to trade those properly, which is the bigger picture, generally speaking, the problem that you run into is that the margin you need does not allow you to build that into a $2,000 account properly enough so that you can build a trading portfolio of multiple trades active at the same time. And this is kind of what you want to do, because it creates a portfolio of mixed assets that gives you stability. And you kind of already do risk management there by controlling exposure, that if one market goes forever, whatever reason, the other way, then you are benefiting from it somewhere else. This is the general idea, right? So one of the habits that a lot of retail traders have, that me no exception at start, is we pick one trade and stick with that one trade for a while, or one chart, which is even worse. Because now you're forcing yourself to look at a chart and trying to make trades happen, because I only trade euro US dollar. I only trade pound yen. I only trade. No. When forex, you trade everything. Preferably, you only trade where the money's moving at the moment. That takes a problem of, you need a bigger capital because volatility needs more. So you set it up differently. But like I said, if you have a $2,000 account, stick to the majors and the minors. When you go from 2 to 5, you add exotics, you add commodities and indexes. And then anything over that, you start building up a portfolio of balance versus risk. All right, balance versus growth, and something in between. Now, if you don't understand anything I just said, don't worry about that. At the start, you don't have to worry about any of that. So let's take a look at a chart. So here, the first thing you need to do is, when you open a chart like this, understand what you're looking at. So what do I see, right? March 2020, I'm looking at a week chart. The reason for the week chart is we're going to do a top-down analysis. I'm going to get back to that in a second. But you want to understand in a bigger picture, which is the ruling body of where the market is moving. And that's the direction we want to trade with. So if it is heavily going down for the last several weeks, in a smaller time frame, if you're a 15-minute trader, you would prefer to find selling opportunities, because there's simply more volume and pressure for sell than there is for buy. Simple as that. Now, what do we see? March 2020. What was March 2020? Why was this big spike? If you don't know the answer to that question, look it up. Find out what was happening in the markets in March 2020. In this case, we all know COVID, right? So that was after a period of going down. It had a jump, then a slam, then a correction, and it kind of moved sideways for a bit. Then we had a climb, we had a rally, which turned into an uptrend, which turned into just a price increase in euro US dollar in this case. Topped out, pulled back, retest, and then started a downtrend that has been lasting for a little over a year. So if in the entirety of last year you've been looking for selling opportunity in your US dollar, your probability of winning was much higher than your probability of buying. Does that make sense? Now, where are we in the market? We're at a previous low price, and unfortunately, when you have something like this, you do need to look a little bit back. Generally speaking, you want to try to avoid going too far back because the market back then has nothing to do with the market today. Remember, pre-COVID, post-COVID, pre-2012, post-2012, pre-2008, post-2008. Understand these critical points in markets and times and when things happened. It doesn't mean you can completely ignore the prices. When you don't have anything else to go on, then you have to look at something. So use the past. And we're looking at 2015, 2016, where it had a big drop and then it moved sideways for a bit and then it got a correction. This is the only thing we can really work with. So does this market stand in a good position? Well, preferably we want to look for sell, and we're in a really low point after 4 weeks of sell. It is more likely that right now we're going to get either a pullback or a turnaround until it gets to the top, and we want to look for selling opportunities when it's at the top of the channel. Now, if you simply would put a trend line from the top down, you already know we're not anywhere near any of the entry points up here. And we are looking at the bigger picture for this, because once the bigger picture is up there, then every single picture underneath it will pressure into a sell more likely than a buy. But we wait for confirmation when we get there. I'll circle back to that. So let's say we just do this. You flip through the charts, big picture. What do I see? Drop, correction, drop. And this looks like a rally, but did it break the trend? This was the old trend, but this trend was more like a curve. It wasn't really a channel. We can just, with the naked eye, you can judge that. And then you have this other bottom, but the bottom wasn't really in line with that. So we had a converging channel. So this broke. So what did it really break? Well, it got to that previous low. And you can see this on naked eye. Right? It got to that previous low, got rejected, bounced back up, hit this level, which is also, again, a correction point, which shifted a little bit, obviously 2019, 2008, it's 3-4% change. And now it's kind of moving back down. So what is it most likely doing? Well, it could either start moving sideways or it can continue that this is the second top in what is going to be the actual downtrend, which is going to look something like this. But we don't know that. There's not enough information right now for us to make that call. Right? So in your position, if you have a bigger account, you can take this sell because your stop loss would be somewhere over here. I'm going to get to specifically how you find that in a minute. Right? But then you can take the risk of it pulling back, take a second position, and then write it down. But when you're a smaller account, you simply just don't have that luxury. So this position, from the simple analysis we just did, we know the market is not in a favorable position for us. It's not high enough in the channel for us to look for good selling opportunities. And it's not low and at the bottom. We can't use the active candle. So that would mean that this would be the trend, which it's outside of. I have nothing to go on. There's nothing I can judge this by. So if it is an uptrend, it needs to stop somewhere, start over, and then go and create a higher high. Then we can start looking at the next time it comes back down. But that is 6, 7, 8 weeks away from now. But we have plenty of charts. That's just the first chart. Second chart. Okay. AD CHF, they're going to look the same. Right, so the AUD pairs we know, but it's different. Versus the JPN, okay, we have an uptrend and we're going down. So this one might be something noteworthy to look at because we had a little bit of a rally. This might be a little bit more of aggressive correction that will then go back down here, right? Now, this is the low point of the downtrend that happened before, and this is the first consolidation point of the uptrend. So this is not the starting point, this is the starting point. So we're here. This, touch that, we look at a possible buy. Again, 2-3 weeks away. So we go next. All right. It's at a high point, could be a potential sell. Needs further analysis, but this is the NZD. 80 NZD is very, very jumpy. It has a lot of wicks, as you can see. 80 USD. Let's take a look at what happened. We have the same drop. Funny enough, all the ADs have the same thing. This is why you don't have multiple positions on the same asset, because then you are over exposing yourself to if something happens to that particular pair. Is this in a good position? No, because it's the same story as the other ones. We're neither in the top or the bottom. It's in the middle of somewhere and it hasn't done anything. So we don't want to go anywhere. No, what Bitcoin's in there? Oh, what do we got here? So, you don't have to follow the trend. Somebody asks, do we have to follow the trend? No, you don't have to follow the trend. There's a saying like the trend is your friend, which is a little bit of a paradox because it's not really your friend because it can also bite you in the ass. But generally speaking, if you look at the bigger picture, the probability of it going with the trend is much more likely than it going against it. But if it is obviously at the bottom of a downtrend, then it stands to reason that it will correct itself back up in a rally of some sort. The problem is when you're in a downtrend and it pulls back into the channel and it goes up, it doesn't always complete the full run to the top. It more likely stops halfway through, has a little bit of a drawback, and then does another rally. The trade develops differently, so you need to wait longer. And when you're looking at a bigger picture, that makes a few changes. So this one could potentially be worth something to look at. We're at a high point. It had an up. It will probably correct. This is one of those things where you might want to trade against because you're not really in a trend. The trend here is horizontal movement for the last year. It's been moving between these 2 points, 75 and 70 cents or 71 cents. Right, so there's a good likelihood that it might, once this, if this closes, and this is another thing, you wait for the confirmation. I'm going to circle back to this and put this all in steps for you. If this closes here, then we know, okay, we'll most likely go down. So if the next week is down and it stops here, then we know we can start looking at sell. And then you could take this entire length. But I know most of you trade smaller, so we'll get back to that. So you just flip through the charts like that and you just find something. So once you find something and you think like, okay, I want to analyze this because this might be worth something. I'll get back to Fibonacci levels in the Q&A if you don't mind, because they're a little bit separate. The answer is yes. Yes, because it's a self-fulfilling prophecy. And like I said, I'll come back to that. I'll hold that for the Q&A. All right, so let's say we want to do analysis on this chart. I know it's not in the perfect spot right now because we prefer it to be in the top so we can sell. But let's take a look. It might be an opportunity to buy instead, which is yes against the trend. But looking at how it dropped, there should be 1 or 2 weeks in the opposite direction at some point as a rally. Fibonacci comes in play here, right? You could have a 32.6 or 62.8% pullback, right? So what is top down? Regardless of what time frame you trade in, so if you trade in 5 minutes, 30 minutes, 1 hour, 4 hour, it doesn't matter. I don't care. You start at the highest time frame that is important for you to look at. If you trade 5 minutes, do 30 in 1 hour. If you trade in an hour, do 4 hour day or day week. So I usually execute on 1 hour and I use week for the bigger picture and I use day for kind of like judgment of certain key levels where it might stop along the way because I usually trade a little bit longer. If you trade smaller, then the same rules will apply from what I'm about to do to what you do. To whether you trade long or short, it doesn't matter. All right, now Let's start with the analysis. Few basic rules. Number one, when drawing trend lines, they never ever cut through the chart, and they never ever use the active candle. This candle does not exist for us. When doing technicals, we cannot use this candle. It is not closed yet, therefore it's not confirmed. This entire thing, it's only Tuesday, it can pull back in one day and become a line. We don't know, so we cannot use it. So let's put some trend lines in. Now what is important when you do a top-down analysis, you already understand you're going to have a lot of lines. And this might actually be equidistant. So let's check. The bottom of the equidistant channel can never start before the start. So you can't have this. It can only ever start after. And why is it not this top? Because that was the end of the up run. First pull, retest, and that's when it started. Read your chart. So here we have, you can take the wicks in this case, but you can see that it's broke if you take the body. In this case here, everything closed inside and it's had several wicks through. This can fully pull back and still be inside the channel. So there's nothing wrong with this channel until it gets colored. If it closes outside in a downtrend, what does that mean? It means we're going to get an acceleration of the selling. There's going to be more people jumping onto the sell, which means it's going to go to a new low, breaking the previous, which probably means we're going to have to look at something like this. And then it's going to stop and then rally. That means that we might need to restart our channel and now shift it all the way down once it creates a new high and start from there, because the chart shifted. But that is several weeks for that to do, because it would be, let's say, another 2 weeks down and then 3 weeks up. It doesn't mean you don't trade anything along that time. Now, why do we color code it? Well, like I said, we are going to have several lines. So we want to color code it. On top of that, in visualization, you want to make sure that it only looks at the highest and then all subsequent ones. So you're going to understand that when you do an hour, you don't want to have a week chart that has your hourly lines in it, because it's going to look really squashed, like a bunch of lines like this on top of each other. Like you won't be able to read what you're looking at. You're going to get stuff like this. Right, you want to have it as clean as possible. Now, we're talking about the horizontal lines, so the support and resistance lines, you want to look at 3 or more connection points, preferably. You're not always going to get it, but preferably 3 or more connection points. And it depends on the chart. If they have a lot of big wicks, like NZD has, then you have to take the wicks into account as part of the chart, because it just has it regularly. In this chart, you can see there's a lot of wicks, but they're all different sizes, shapes, and the bodies basically make the actual chart. So in this case, we just focus on the actual candles. Now, if you're then struggling to say, like, okay, but where are these levels? Now, some people say, okay, well, this is the high, we'll start with that. It's not wrong. But keep in mind, when you're trying to analyze, you're looking at where are my key critical points on the biggest picture that I need to make sure that I do not trade when we're near that level. I need to wait for it to turn, or I need to wait for it to break, or I need to wait for a confirmation to happen. If we think about this level and the price where it is right now, this would take a year to get there. There is no point in trying to figure out all the lines along the way here. You are not going to be taking a buy and holding it for a year. So don't waste your time. Be efficient. We're at the lowest point right now. The previous low point is here, which we broke, but we're still going to keep it because on the way up, it might become relevant again. Now we have to look at what else we have. We only have this. It was one connection point. You cannot use this. So now we have to zoom out a little bit. And then we get, okay, where do we get clean 3 connections? Now, if you struggle seeing this, use the line chart. The only thing the line chart does is show you the closing prices of the candles, meaning you take all the static noise of the wicks out. And now you can cleanly see where's the cleanest touch. Now, if we take this lowest point right here, we have 1, 2, 3, 4 that are almost touching it. If we then go back to candles, we can see that all the wicks touched them, which means we had multiple rejections on this price level, 105. So that is most likely going to be a very critical point for this thing, and it's probably what it's doing. Like probably touching that, then you're going to have a lot of prices of a lot of sellers that are going to close their positions, which is going to flip the volume back to buyers. And then people are going to start buying because they see it going up. So everybody presses the buy button, ergo, you get the rally. I understand in your head what happens in the market. What are people doing? The market moves based on money going in and out. So understand why money is going in and out and at what points. Now let's look at the way up. What else do we have? Well, now it becomes really muddled because we have this point that we can look at, which kind of corresponds with this point, but not really. And we maybe this. See, this is where it gets muddled. Use the line chart. Oh, okay. Now we can. Well, we have this point, which doesn't really have any connection thing with others. It goes through everything else. Now, if I take this point, we have 1, 2, 3, 4, 5. We do it like this. Boom, wicks. So most likely, this is the cleanest, in this case, resistance after it going back up. This is another week, and if it goes even lower than that, you can say, okay, I'll take this one as well. Right? I'll just lock that one in as well, just in case it goes past this one, then I know what the next level is. But you wouldn't start selling because now you start going into a very dangerous territory where it becomes risky because you know eventually this thing is going to turn. So now you're getting into the territory of swing traders starting to set up their levels of starting to add buys every 100 pips, 2,000 pips, whatever it is, where, ladder strategy or martingale or something like that, where you start getting more and more volume the opposite direction the lower you start going because people are starting to think this is the time, this is the time, this is the time. We're just going to sit there and wait. Let them waste their money. We wait, we'll collect it afterwards. So now you do this the same for, like, let's say where they said the other time frame. So if you start on a week and then you do a day and then an hour and color code them. So I made the week blue, then you can make your day green, your 1 hour red, or your 1 hour purple or orange or brown, whatever you want. If you've done all that, it'll look something like this. And then you go to day and you'll see green starts to show up. And you only take into consideration what's important for you at the moment of day. And then you go to 1 hour. No, did I do it in 4? Where's my brown? You know what? Doesn't matter. We'll make it real fast. So that would look like brown. Because I said brown. Well, you're going to use brown. Right, so we got this has to start afterwards. We don't have anything here. And you will see that in the smaller time frames, the rules change more often. Now, in a downtrend, the price can close underneath the line. It cannot close above it. Closing above it means the downtrend is broken. Closing underneath it means it just made a little bit lower low because people held it a bit longer. Does it make sense? So in an uptrend, it can close above the trend. And you're buying in an uptrend anyway, so okay, you got more money. I don't hear many people complain about that. But this is why it's also dangerous to jump the gun. You wait for confirmations. And we're going to get to that in a second. So we have this one. Let me just slap in some horizontal lines real fast and a day. So we had this, that's a few days. We want to have it brown. So we know that this is a day. Probably make the line a bit thinner as well. I hope this is all visible for everybody. So you just apply the same rules that I told you before, right? So look at the most stable. Here we have that rejection and then a level here. If we go back to candles, we see there's a bunch of wicks that have got stuck. That was a wick that touched it. So here, this candle got rejected by this resistance, and here it got rejected by the actual bottom of the channel. This is why when we start talking about stop loss take profits, it's going to start making sense why I say where it goes. Because I know a lot of you have like, I always hit my stop loss because you put it too tight. Now, judging by the distance between these two, the next one's going to be roughly here, which is basically where it is. I don't think there's another one in between here. Could be somewhere over here. We don't have the information for that. We can start digging around in the past. We have to go very far back, I think. Oh, here. So this is the lowest point after that. Which, yeah, it's just underneath where it is. So that makes sense. Right? So you do that, easy peasy lemon squeezy. You have now your level. So do you execute on the bigger picture or on the smaller picture? And now everybody just woke up again, just like, oh shit, he asked the question. Do we execute in the big picture or do we execute in the small picture? And anybody who feels ballsy, they can say why. Oh, we got a nice mix here. We got something in the middle, something in the small, something in the big. Who thinks big and why, and who thinks small and why? These are questions you should ask yourself, right? I'm not triggering you to think about it. I'm going to give you the answer in a minute, according to my experience. Ooh, close Malamogi, but it's the other way around. So in this case scenario, guys, we're doing a week is the big picture, day is our middle frame, and then 1 hour is the small time frame that we're trading in. If you trade at home with 4 hour, 30 minutes, and 15 minutes or something, then obviously that'd be your frames. But Yuri, you're spot on. So the execution you do in the smaller time frame. Now, there is a side note to that. We look at the big picture to see where the market is, and if we are at a resistance or no, I didn't give them a thing. So this is how you get rid of that. I only want to show those in hours. I only want to see them in hours, because otherwise it becomes like, you can see you get all these little lines everywhere, and they're just going to confuse you. That's why you also color code them. I don't know how it's going to work for people that are colorblind. Use colors you can see, I guess. Sorry. Make colors that you can distinguish. Let's put it that way. All right, so we look at first the big picture, because if the market price is close to a big picture resistance line or trend line, that is the ruling line that is important, whether it gets broken or not. So we wait for that. So if it is a Thursday, if it's Thursday, let's say it's Thursday right now, we have one more day to go. That means I am not going to execute any trade on this now. I will wait for the closure on Friday to see where it actually ends up, which will give us a cue on Monday to see where it opens and if it then corrects itself, yes or no. Once we have that information, we can now look at the smaller picture. Let's say the market is now favorable for us. Let's take this scenario that we're over here somewhere. Then we can decide, okay, hey, now I want to execute. So one of the things that you can apply is your indicators, right? So let's say you use stochastic RSI, MACD, and triple moving average. Then you look at in the smaller picture compared to the bigger picture if they line up. They both need to tell you the same information. Then you combine that with things like price action, where you have and which is more on a smaller time frame, when you have a confirmation on that as well, then you know, okay, the probability of this trade now doing the follow-up that it always does is much higher than me randomly guessing. You now have confirmation on both indicators, on technicals, and price action that I am done dropping. I will now turn. And then you could take the buy or the sell, whatever the market is in. Now, let's say the market is not right now in the position yet. What do you do then? Well, this is where that point comes from. You now start to think plotting. So we'll circle back to that. But this is what I said before. Understand of where the market is, how it got there, and why it's there. If there's an exceptional, like a really big spike, understand where it came from. Most likely, it's going to be for a fundamental reason. Interest rate decision, all kind of things, right? Geopolitical, does Russia things, something, right? Oil right now, Russia, right? So understand why markets are doing things. You don't need to know the intricacies of why it's important that this does that. No, but understand what the connection is. So you can start monitoring, which is more for commodities and stock. But we'll get back to that. So now we can use our technical analysis to find our optimal entries, take profits, and stop losses. And trailing stop I'm going to get back to because that's a love-hate thing. Some people hate it, other people love it. I'm going to explain to you why you should be using it. With the exception when you don't. All right, so we now have our lines. So let's look at the bigger picture first, because here we can find our optimal entries. What would be an optimal entry? Right here, right here, right here. Anywhere at the top of this trend line, and preferably just underneath one of the resistances. Why? Because in the ideal situation, we want to have an entry where the stop loss goes just outside two resistance points, so trend and flat resistance line, which means it actually has to break considerable amount of resistance to get to your stop loss, reducing your risk of you losing trades. And some of you might think, but those are huge distances sometimes. True, but pips are useless. Pips have no value until you put a lot size to them. And we'll get back to that in a minute when I'm going to explain to you why you use variable lot size. Except if you use certain strategies, then, but that's beside the point. None of you should really be using those. Okay, but so let's say what we want to look for preferably is a buy. So this, we would prefer to see it pull back by Friday and do a move like this. And then our optimal entry would be right here. Object, shape, clips, bloop, bloop, bloop. Hey, work with me. Why didn't you not make a circle? Why is this thing not becoming a circle? Oh, there we go. Our optimal entry would be in this level. It's a bit big, isn't it? Can I have the circle back? Yep, sometimes this doesn't want to work with you. Circle, where are you? Thank you. Make it a bit. So our optimal entry would be right here somewhere. But we already know that's going to take several weeks. But that's our optimal. So we do set a marker. If you have multiple charts, some of them might already be heading there. So let's say this has already got 2 or 3 green candles and it's somewhere over here. Then we know maybe next week, maybe the week after that. I'll set an alarm when it reaches that price level because, hey, that's for me a cue that I should start paying attention because the optimal entry point might be coming up. And it's going to give me a few days of opportunities to make a decision to go in. Right now we're over here. So now think about the scenarios that can happen with the current market that we are in. And for those that were asking earlier about trading with the trend only, no, but this is our optimal. So if you have a really small account, let's say $500 or $1,000, yeah, you have to play the patience game. You have to time the market right, which means you wait for this moment. Which, yes, means that sometimes you're not trading for like 3 or 4 weeks in a row. And then you can finally open 6 or 7 trades because all the markets line up. But that will end up with more positive results and bigger trades and thus more money by the end of the year than you trying to trade everything in between. Right? Trade smart, not hard. So let's say you're in the bracket of $1,000 to $2,000. Let's do a $1,000 account. I think that's, well, the average is 1,200. So let's take a $1,000 account. Current market price, where we're at. Do we have any confirmation? Is there anything to go on? No. But we do know it's Tuesday. So would you enter now on this candle? No. When would you enter? Perhaps on Monday, which is only a few days away. So where would we preferably go in? Well, if this pulls back, can I just, there we go. If it pulls back, here. Hey, stop. All right, whatever. There. In this area, because the next candle is going to be next to it, so it would be somewhere there. But if it pulls back and the next one opens and doesn't break this line, and it opens and it closes, let's say it pulls back by Thursday midday, and on Friday it ends up closing just above this line, and Monday opens above this line, then that's your entry. And you need to start not being scared of pulling the trigger. And I'm going to explain to you in a minute why you shouldn't be scared of that. Another possible entry is if this does complete and it stops outside here and Monday we see a green candle, then you would probably wait till it goes back in. But if you have a $1,000 account, you could go in here on that Monday. Why can't I? I want this candle. Thank you. Optimal, better, suboptimal, but still a good entry. Anything in between is a terrible idea. And that comes down to the following point. Let's put our entry point in. And I know I'm looking at a week. We're going to get back to that in a minute. We're going to do this on a day. The rules apply whether you're on a day, a week, an hour, 5 minutes. Please don't trade on 5 minutes. But if you're on 5 minutes, doesn't matter. And optimal entry would be here. Why would my optimal entry on the bigger picture be here? We'll make this easy. If that is my entry, yeah, I should have done this the other way around, but okay. Let me close those. Get rid of those two. All right. So here we go. Do we have numbers in this? I don't remember if we had numbers in this. We do, don't we? It's text, I think. Yeah, we're not gonna do that. All right. Guys, just work with me here. We'll just type in 1. 1. 2. 3. Now, obviously, when we're here, we're looking at a sell. Big picture sell, perfect entry for sell. We want to take a sell. Ready with me? What stop loss would you take? Number 1, number 2, or number 3? There's some ones, there's some twos. Okay, thankfully nobody's saying 3. And as I said, people type in 3. Don't feel bad. Okay, so if you would go in on this point and your stop loss would be 3, there's nothing wrong with it except for it's a little bit on the big side. And you should be way out of the trade by that point, because the only way it can get to 3, if we go in here, it needs at least 2 weeks to get there, which means it had already 2 confirmed candles outside of your channel. That trade is dead. So for that reason, we don't want 3. But what about 2? Because a lot of people looked at this wick and got like, well, I want to be outside that wick, so that doesn't happen again. Is that true? Who thought 2 because of the wick? There were quite a few 2s, so come up. I know somebody looked at that. Now, although that is a true statement that you want to be outside the wick, this wick happened within the channel, which it is free to move into. To do it here, it needs to break not only the channel, the resistance, it needs to go all the way out to get there. And even then, from entry, if we look at the distance of the wick is 135 pips, it would reach the same level here. Come on, work with me. Right here. So you would still not be there. So 2, although is a little bit on the safer side, you would actually go with 1. Because it needs to break. If we go in here, it needs to break both the trend line and the resistance to get there. And remember, we're not going into this trade when the green candle gets here. We wait for the green candle to close underneath it and the red one to start. That's when we open it. If you're a swing trader, you're already setting up buy, sell, 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 like every 50 pips. That's a completely different way of trading, and you need money for that. Like, a lot. Now, why do we calculate stop loss first? Because nobody cares about more money. I've never heard anybody complain about I won more than yesterday. I've heard plenty of people complain about I lost again. Me included. No, if it breaks the channel, you wait for the pullback and then you redo the analysis the other way around. You wait for a second bottom and then you go in, because that's a safer guess. If you have a bigger account, you can already start buying into the new, but forget about that for now, Walter. But yes, it gives you a cue. Okay, so let's take a look. We know our stop loss. So now we know the distance where the stop loss is going to be with our entry point. And this is optimal. Now, whether you're doing it here or you're doing it here, it doesn't matter. The rules apply the same. But first we're looking at optimal, then we're going to look at the 1 hour. And I only have limited time, so I can't do all of them. So now that we know our distance, and this is where the variable lot size comes in. It's a 90 pip stop loss. I know for a lot of you, it's like, oh, wow, 90 pips, that's a big stop loss. I usually do 15 pips or 20 or 30. Yes, and this is also the reason why you're losing 70% of your trades instead of winning them. Because your trade is like well within the ADR. I know it's a bit mean what I just said, but hear me out. 90 pips has no value. So let's do an exercise. I have a $1,000 account, fresh. My risk of trading with the trend is 3% of capital. What is my value risk? If I have a $1,000 account, what's 3% of 1,000? And who's using a calculator? You guys are so quiet. Come on, 3% of 1,000. Who's got this? Thank you, Jane. 3%, Glenn. Typo. Don't worry about it. There you go. Yeah, it's $30, right? 3% of 1,000 is $30. So now we have a 90 pip stop loss. Okay. At what lot size does 90 pips equal $30? Well, let's start simple. If I do a mini lot, what does 90 pip stop loss become? Well, a mini lot is $1 per pip. I know some lot sizes are slightly different depending on the thing you're trading. By average line, it's going to be $1. Unless you're trading exotics or commodities where you have, it's either a tenth or something like that. But once you get to trading that, you need to learn that first, and then you can do this. So let's just take $1 per pip. That would make the stop loss $90, which is 3 times too much. So what does the lot size actually become? Okay, well, let's take a micro lot. Now it becomes $9. Well, that's too little. Oh, wait, hold on. 3 times 9 is 27. That's pretty damn close. So I can take this trade on 0.03. And I'm only risking 3% of my capital. Now, the percentage of your risk is all up to you. You can do 5 and 2.5, right? 5 with the trend, 2.5 against the trend, stuff like that. But make a number you're comfortable with, regardless of what number that ends up being. But keep in mind, you want to fit it so you can take 10 trades at a time, because you want to eventually build a portfolio of trades. Remember, we're risking 3% of our account. So if I take 10 active trades at once, all at 3% of my account, I'm only risking 30% of my capital at any given time at the same time. And because it's 10 different trades, you're not actually risking 30% because obviously you're not trading just euro or just dollar. You're spreading out your risk over different assets, risk management. So you're building a portfolio of trades that you switch in and out of and have replacements for. And so you might think, okay, at the start, I don't have many trades. True. But eventually, you're going to have almost 10, 15 trades active at any given day. And then one closes today, the other one closes in a week, another one closes in an hour, and then you're flipping and you're changing and you put a new one in that might develop in 2 hours. You have one that might be set up for a week because it was at the week entry, stuff like that. All right, so we have a micro lot. Now let's take a look before we open it. Where would our take profit ultimately be? Let's do the same thing again. 1. Give me the 1. Oh, we're gonna play this game again. Fine. Do we do 1? You know what? You guys understand what I mean by 1, 2. Do we do number 2? Or is it number 3? 1, 2, or 3? What's our take profit? Bayana's like, yeah, all of them. You could take all of them, but you're doing 3 trades then, eh? They could all be your TPs, yeah. But which one would you prefer? If you can do partials, take partials, yeah. But that's a bit more advanced than when you start splitting up your trade in different, and then you do it the other way around as well. When you're growing, you add, increase the lot size along the way. 2, stop loss above 1. Yeah, we're gonna get back to that stop loss above 1 thing later. Not yet. So in general, the first idea that you have, 1 would be too short. But we are going to use 1 for something else. 2 is basically based on if this actually ends up here and it goes back up, right? So if it then gets here, then you had a trade here, and then you go back to the previous low. The other thing you can do, and that is when it is nice doing this inside the trend, is you calculate the average growth. That's 130 pips. That's 200 pips. 140 pips. 200 pips. So 140, 200, 140, 200. So an average is like 150 pip growth of a new low. So from here to the new low would be here, and then underneath 150 pips, which would be roughly here. And if you look inside the channel, that would be roughly here. So you would actually take 3 in case it spikes. But 2 would be the safer bet. We have a beautiful ratio because our entry point is optimal, because this is a 90 pip stop loss to a 400 pip take profit. Mwah. Beautiful. Safe trade, risk very little, 3% of my account. And if the trade works out well, now I can calculate it. 30 cents times 400. 3. Now I'm doing top of my head. Hold on. It's been a long day. 30 cents times 400. Come on, Mike. 30. $120. Risk 30 to make 120. On a $1,000 account, that's 12% ROI. Not bad for a few weeks of waiting. So now let's plot the trade, and then we're going to do the same thing in 1 hour, and then we have to keep moving because we're running out of time. So how do you plot the trade? Well, there's a very simple trick to this, the way I do it. In a downtrend, it has a certain angle that it takes back up and back down. Up, up, a little bit faster. But this was a down. For some of you that are now looking at what I'm doing, they're going like, well, isn't that Elliott wave? Yeah, we're not going to talk about that right now. Okay, we're doing the plot on the weekly right now because we did the calculation on the weekly. If you do this on an hour, you do it on an hour, obviously. Right, so we can do the exact same steps we just did, but then on an hourly. And now we got another one going here. So if we take all the down ones, and then there's this. So the start was slow, and you can see how it starts to, if we put them all on top of each other, what do you get? You get an average, which is pretty much that. So we take that from our entry, we put it down, and you can see that third TP that I put in is basically where it's going to hit these two. But you can now plot, and then when you plot it like this, you can also just measure this and just say, okay, it says 5 bars. So if I do execute this weekly trade, this will take about 5 weeks to complete by average. Makes sense? 5-week candles is 5 weeks of time. So if you do this in an hour, oh wait, let me get rid of all this. So you can now do the exact same thing on an hour. You get the exact same calculations. You do the exact same steps. You can do it on 5 minutes. It doesn't matter. It's the same rules. I just did it in a week because it's nice and clear and clean. If you do it in a week or in an hour, same thing. If we want to take a trade here, a buy, because a lot of you are looking at this, I want to take a buy. Where's my stop loss going to be? Here or here? What happened to my... yeah, all those lines we put in, they're gone again. I think there was another one somewhere over here. I'm not exactly sure, but I'm not going to calculate it again right now because we're running out of time. I think the next one was below us right here somewhere, and it was on the line right now. So I think this was a resistance, and the next one was like somewhere over here. So is it over here or is it over here? Be careful how you answer that. 1 or 2? Okay, so some of you say 2. So 2 would be optimal, but for 2, you're more looking at the bigger picture like a day or a week. For an hourly, you wouldn't take 2. You would take 1. Your outside trend, outside resistance on the hourly. So if the hourly gets there, it can do that. These are the trades you lose more often, and especially if you're in a downtrend and you're selling at the bottom of the channel, or you're buying at the bottom of the channel, you're going against the trend. It can make a jump, which in an hour might seem like a lot, but in a day, it means nothing. It's literally just a little bit of a bump. This is where those losing trades come from. So this is why in a smaller time frame, you want to trade with the trend even more. Right? In a bigger time frame, the down, up is very stable. The smaller the time frame, the more unstable it gets. The more it decides, well, today I'm going to do double up and then one time down, and tomorrow I'm going to do double down and one time up, and then I'm going to do up, down, up, down, up, down. But in the bigger picture, all those movements disappear because all those little micro movements are basically just wicks in a candle. Right? So keep in mind. So let's say you do go in right now. Make this green. Oh, I got the chat in the way. So let's say I go in. Now you do the same thing again. You measure the distance. This is a 40 pip stop loss. I have a $30 risk. Okay, mini lot would be 43. So it's 0.08, top of my head. Something like that. Then I can judge now if that would be, where would my take profit be? Well, based on this movement, let's take a look. What's the average move to the other side of the channel? That one was almost horizontal movement. Up, up, but this one stopped halfway. There's probably a resistance there somewhere that we didn't plot right now. Yeah, there is. It's right there. See? Hey, work with me. Right, so if we look at all these, I think the average we can say is something like this. So we take our entry point, we extrapolate, boom. That trade will take 8 hours on average. Now we know where our take profit is. We already know that that's our stop loss. This is our stop loss. Then we take it where our entry is. It's 35 pip take profit. And now we know this is not a good entry because from this point to here, the risk reward ratio is just not good. We're risking almost as much as we're trying to make. We want to look at 1 to 3 preferably. However, it's not realistic to get 1 to 3 all the time, especially in smaller time frames. On average, if you take, let's say, 100 trades, your average should end up with 1.3 or better. If you're underneath that, you're taking way too risky trades too often. Because remember, if you're trading 1 to 3, every loss you take, 1 win will cover 3 losses because you're trading on a percentage. There's a webinar I did on variable lot sizes that shows you if you extrapolate this by 100 trades, even if you have a 40% win rate, which means you lose way more than you win, you end up with a profitable account. It's really funny how that works. Okay, so let's say you have your trade. So let's take an example that we go in here a little bit later, like it goes down a little bit more. Our stop loss is over here, and our take profit is over here. This ratio would work, I think. 22, 40, 1 to 2. It's fine. You could probably make this a little bit shorter. But okay, how do you calculate the average, your trailing stop, and why? Okay, now I know if you are in front of your computer all the time and you are manually trading, as that's all you do, then manually doing micromanagement is much better. Yes. But I don't find this realistic to say, and I hate it when people advise it because most of you, not all of you, have a job, and that's where you're at most of your day. So you don't have a computer in front of you to monitor and micromanage and shift and move the stop losses. And please don't say, yeah, but I use my phone. Don't. Terrible habit. Throw it in the garbage. Don't use your phone for trading. The only thing you ever use your phone for is to emergency execute a closure, not calculating different lot sizes and stuff like that. Because you just need more information. In my opinion, you need a good screen. You need to properly sit down and have all the information available, which you just don't get on your phone. You just don't have the tools. All right, so when we're going up, what do we care about? It's when it pulls back down. So let's take a look at when it goes up, how much it pulls back. So average daily rate, or ADR, doesn't just apply to day. It applies to whatever time frame you're looking at. So if we're trading in an hour, we care about the average hourly rate, let's say. So when we're from down here and we're going up, there's going to be pullbacks along the way, most likely. So let's take this as an example, because this one was basically horizontal. Right? So here from bottom to top, that's what we're looking for. When we're going up, what are the pullbacks? 12 pips. And here I usually do take the wicks, 10, 18. Now let's take a look at this one. 16, 14, down, here we go up, that's all nothing, we don't count that. 12, all right, fine, I'll count that one. 6, and then we didn't have one. So on average, it's between like 10 and 15, right? Well, if it is between 10 and 15, then anything above 16 would be exceptional. Now, obviously, it doesn't really matter much here because it's only a 30 pip trade. But when you look at a little bit bigger trade, if this channel is a little bit wider, for instance, in a day, you will see that it's more than half. And this is also why you color code. I know exactly what colors I'm looking at. I only care about the green ones when I'm looking at the day chart because that's my day chart. The blue ones, I only care about if it is near there. So if it's Friday and it's here, I don't care about the day chart anymore. I want to know where it ends up on Friday. So I only want to know where it ends up here. Another reason why you color code. Anyway, so let's say we're down here. We have that execution trade. Let's say this lingers a little bit on and it really comes down here. Perfect entry. And then we can probably put this like up here. And it's a 39 to 16, with perfect. So we average calculated between 10 and 15. So if we take 15 as a number, then add about 20% over, right? So you add another 2 pips, 17. So you set up this trade. We now know, not great. We now know that our lot size is 0.08. We know our execution point, so we'd open it. Then once it is open, add a trailing stop of 170 points, which means that once this trade starts going up, the second it hits this point, about halfway, the stop loss will automatically move to 0, and now it will just automatically move. So if it turns back, yes, it sucks when it does that and it hits your stop loss just after it moves, but you already know, you calculated that the movement needs to be bigger than what it averagely does. So there was a reason for it to do that. Could have been a news announcement you didn't check. But if it isn't, and by all normal rulings, it should just go to your take profit. And if it doesn't and it misses it by 1 pip, which is always the most annoying thing ever, and then pulls back, at least you secured most of your trade. At least you didn't end up with what you have. I guarantee from experience that you've all had this. I had a trade, it was almost at take profit. I walked away. I woke up the next morning and I saw it hit my stop loss instead. If you would have used the trailing stop, you would have secured and you would have made some money. It's that simple. And when you use MT5, the trailing stop doesn't activate when you put it in. The trailing stop activates when it reaches the certain amount of pips in profit. So it's like moving your stop loss to 0 automatically without you having to be there or monitor it or anything else. Okay, so Estimating our trade's duration, we already covered that, right? So you take the average length and then you just measure it 5 weeks, 8 hours, I showed you. So you can do in the smaller ones, fine tuning your entries like we just did, a little bit lower this, a little bit higher that, but you do that mainly when it actually is there. You wait for price action and then you fine tune your take profit, and you look at like, okay, what would be criteria? So if you have multiple hourly resistances in your hourly trade along the way to your take profit, then you know these are points that you might want to put up an alarm to make sure that you can keep an eye on it. But don't be too scared if it stops there and pulls back a little bit. Remember, you calculate a trailing stop. You need to commit to your trades, because if you start pulling trades out all the time and closing them early, now you're screwing with your risk management, because you're completely screwing up your ratios. Yeah, I'm trying to get 1 to 3, but I always end up with 1 to 0.5 because I close my trades early because I think they're going the other way. It's okay to lose a trade. It's part of it. But if you don't commit to your trades, you're never going to get those full, nice green run trades. They're not always going to be there. Right? Let's say you have a 60% win rate. 3 of those trades are actually hitting take profit. The other 3 are probably hitting trailing stop or just close to it, where you close it manually because it literally stopped just underneath it. And if you're then looking at, look, I'm 5 pips away from my trailing stop, or if you have a 500 pip trade, I'm 10 pips away from my trailing stop, or 50, then why am I risking making another 50 pips by pulling back 300? Right? Now it doesn't matter that you're in profit. You're now doing the same calculation again. Current market price to take profit is my entry. If the stop loss or the exit point of the pullback is further down than what I'm trying to make, then you close the trade. But you want to be careful not doing it too often, because again, you start messing up your ratios. So calculating your lot size, we did that, right? I showed you. You have your entry, you calculate your stop loss, you know the distance, and then you factor whatever your risk percentage is, 5, 3, 2.5, whatever it may be. Now, one last thing you do is before you open the trade, so you have your, you have your indicators confirm to you that it's a buy. You're at the bottom of the channel. The technicals are confirming it to you. The last thing you do is check the economic calendar, because now that you've plotted the duration of your trade, you know that, okay, if this trade is going to take 10 hours, is there any announcement for the pair that I am trading within the next 15 to 24 hours? Because the markets might start pre-placing items, or they start closing positions because they get antsy about the announcement. And if it's during the duration of that trade, understand the fundamental and maybe move the stop loss to 0 when you get the chance before the announcement hits, even if it hasn't hit your trailing stop point yet. But just move it anyway, just to make sure that in case it does spike down, you're not taking a loss for no reason. And if it does spike down, then stops and pulls back in, you just re-enter the trade. All you lost was time. At least you didn't lose money. I know money is time in some cases, but we're talking about FX here. So it's okay if you lose some time and you just have a trade that went out at 0. You may have gotten a better entry point because it spiked down even lower than your previous entry. And with most economic calendars, they're just knee-jerk reactions, so they're going to correct themselves and continue along whatever it was doing anyway. Now, if all these things check out and you went through your flow chart, you did all your things, it's go time. There's no other reason for you to not press the button. Just press the button and go. You did all the math, you calculated everything, you know it's a 3% risk. You should have no fear of, even if it hits my stop loss, you know what, I got other trades, it doesn't matter. Go. Right? You will lose trades. It's part of the game. It's perfectly fine. You will have bad weeks. You will have good weeks. Proper risk management, different webinar. It won't matter. All right. Having all that said, for those that are leaving us from the webinar and for those that are watching on YouTube, I would like to thank you all very, very much for tonight's, for attending and for watching. I hope you liked it. For those on YouTube, feel free to click on the like and subscribe and all that stuff for Legacy FX. And if you're not a customer of theirs, check them out. They're a good broker. Now, for the people in the webinar, before we go to the Q&A, for those that are leaving us and not staying for the Q&A, again, thank you for joining us tonight, or me. But usually at the end of the webinar, when I close it, it sends out a survey. I would highly appreciate it if you could fill it in. It's about, me, the content. It's anonymous, so if you thought it was terrible, then feel free. You won't hurt my feelings. I mean, criticism helps you grow, but it also allows you to give feedback on what would you like to see? What else would you like to see? Is there a certain topic that you like to see? Somebody suggested, I thought it was an English lesson. Not really how that connects to forex, but if that's something you would like to see, then go for it, right? But you get the idea. So it's completely free, and fill in your feedback. Your feedback helps us create more content for you guys. Having that all said, who wants to take the first question? Fire away. Floor is yours. For those that don't know where the chat is, there should be a question mark somewhere on your screen that when you click on it, it opens a chat. Simply type in the question you want to ask. I'll read it out so we don't get the same question over and over again, and then answer it to the best of my abilities. If there is a question about, I don't know, a book or something, if I don't know it, I will tell you I don't know it. I'm not gonna tell you stuff that maybe or something. Fair enough? All right. No, you cannot see the questions or read the answers. It's literally just, it's a chat to me. So I will read out the question, and I will say, like I am talking now, I will give the answer with examples if possible. All right, so let's starting with the first question. There's a question, are 4-hour time charts trading valid? Well, yeah, because that's mainly the way that I trade it. It wasn't until later that I started using 1 hour. I mainly did 4-hour. So yes, and the application is the same. You do weekday 4 hours. Right, that would be your top-down analysis. Generally, you don't want to use month unless it is really in a really non-reference territory, so an extremely high price or an extremely low price, and you really need to look way back with understanding that that market is not related to the current market, but at least you'll have something of a level to judge. And if that doesn't work, there's another way. Then you extrapolate your lines. So if you had a different, if the average distance is like, let's say 100 pips between every resistance, just keep plotting it over the current market price. So you at least have something to go on. It'll probably not be 100% accurate. It'll probably shift a little bit. Then you can change. All right. Answer now. With a small account, will it be better to scalp trading to build an account? No, Marius. So scalp trading, the actual technique for scalp trading is actually doing multiple hundreds of trades per second, going in and out, doing micro pips. 99% of brokers don't allow micro pips at all. We only do pip. Micro pip is that fourth digit behind the comma. We don't use it. So it already becomes difficult because you have to do is actual pips. And to make scalping work in the correct way, you need a 99% win rate. At 98% win rate, you're breaking even. At 97% win rate, you're blowing up the account. This is generally used. Now, if you're talking about scalping when there's news announcements and you kind of grab a quick trade, it's not really scalping. We started calling it scalping, but it's not what scalping really is. Generally speaking, scalping is extremely risky because you don't have the setup of actually setting up, okay, my entry is going to be here, my stop loss is here, my take profit is here. Now you're going to learn how to do this really fast, right? For me, it's muscle memory. I calculate the stop loss and the lot size is all in less than a minute. But when you're scalping, you're opening trade, closing trade, opening place, trading trade, take 2-3 pips here, 2-3 pips there. And when you do that, the second it turns around, you can't immediately close it at 2-3 pips. You take a stop loss of like 20-30 pips. So if you've done 10 trades of 30, one stop loss loses it all. Ergo, the 99% win rate is what you need. So it's actually a very, very, people think like, oh, you trade a lot and I make a lot of little small amounts and they count up. Yeah, but when you lose so big compared to what you win. You're working with negative ratios. So it's actually an extremely risky trading style. You need to be really fast, and it's really not good if you're not going to be like on top of things and really quick with execution and decision making. So generally, I advise anybody that's new to against it. I hope that answered your question, Marius. Okay, for those that have questions about legacy effects in things like deposits, opening accounts, bank transfers, all these things, guys, go to send an email. I'll send it to everybody right now. Please confirm that you can see it. Webinars at legacyfx. If okay, for some reason I can't type anymore. Send to all. You should all have an email right now. Webinars at LegacyFX. Any questions regarding policies with LegacyFX, regarding accounts, regarding setups, regarding all these things, send it to them. The lady I work with from the company, well, apart from the owner, they will be able to answer all those policy questions. You know, I work with them, not for them, so I don't want to answer questions about their policy because I don't know their policies to that extent, at least. Okay, so when I said, so with legacy effects, I can't trade 0.01, it starts at 0.1. So you can't trade micro lots, you trade mini lots. That's fine. All you need to consider then is that certain trades, you need to learn to walk away. Right? If the trade is less than a mini lot for your setup, then find a different trade, which means that you have a little bit less opportunities when you have a smaller account, which is you have two options. Either make the account a bit bigger, so add some deposit to it, make it like a $2,000 account, then you should be in the range of doing mini lots fairly often on the majors and the minors. Now, if you're trying to like, oh, I can't do this at all. Commodities and stock and indexes is one of those where it's a mini lot on those, sorry, a mini lot is actually the value of a micro lot. And you can't trade a micro lot on it because you would literally trade less than a cent per pip, which doesn't work. But for most cases, if you have a $2,000 account or less, you should not be adding commodities to your portfolio yet. But when you are not allowed, with Legacy FX, you can't trade a micro lot, so 0.01, but you can only do 0.1, then just have the patience to wait for entry points to be at the best point. All right, just be patient. It doesn't mean you can't trade with them. You just have to be a bit more patient. There might be some opportunities you might have taken normally, but you can't now. If the lot size would be 0.08, so 8 micro lots, and you have to end up using 0.1, this is a choice you need to make yourself, whether you want to take the little bit of extra risk compared to normal. It depends on what your risk percentage is, right? I usually say 3% and 2%, which is 3% with the trend and 2% against the trend. But it could be that you're using 5 and 2.5 or 5 and 4. Generally, I wouldn't go over 5 because if you have 5% per trade and you have 10 trades, you're utilizing 50% of your capital, factoring in the European cutoff at 70% margin call. That means you have 30% range of completely free. You will never get margin called because everything together would be a stop loss of 50% of your account. And if you have your balanced setup of your portfolio, that will never happen. And remember, if you have an average of 1-to-3 ratio, even if you lose 7 of them, the 3 that you do win cover all the losses of the 7 you lost, probably with a little profit. So there you go. I hope that answers that question. I will ask if you can quickly again give us the formula for calculating loss side based on stop loss. By the way, we got a lot of questions. I'm not going anywhere. Please be patient. I'll get to all of them. So the formula for calculating lot size based on stop loss. All right, so this comes down to what is my account and what percentage risk am I taking per trade? Figure out a number that works for you. If you're not sure, take 3%. That's a pretty safe bet. It'll help grow the account and not risk too many, and you have a lot of room. So if it's 3% and you have a $1,000 account, for instance, 3% of 1,000 is $30. So if you would have a stop loss of 30 pips at $1 per pip, which is a mini lot, which with legacy you can trade, so mini lot, you have a 1 mini lot trade. You have a $30 stop loss. Right? So just practice this a little bit. You'll get used to it. Right? If you have 1,000, if I would have a $1,500 stop loss or $1,500 account, what would be 3% of 1,500? Well, 45. So if it's 45, and my stop loss is 90 pips, okay, 45 fits into 90 twice. But it's the other way around, so it's half. Okay, so 0.5. Because at one lot per pip, it would be a $90 stop loss. I need half of that, which is my 45. So half of a mini lot is 0.05, 5 micro lots. And there you go. Now this is more going to be for people that have an account up to $2,000. Anything over that, you're going to quite often already trade mini lots. When you start getting to around 5K, you start trading standard lots even. And then you go to a certain level where everything is a standard lot and higher. I think the biggest one I've done was 24 standard lots or something nutty. Because then you start also deciding at some point, where's a cap? What do I cap it? Depending on how confident you are on it, right? I hope that answers the question about the lot size calculation. Oh, Ryan already left, but thank you for the kind words. Glenn asks, would you hold an FX trade over the weekend? Yeah. It depends on where it is. If I am at the starting point of my trade, sure, hold it because there's a reason you opened it. But you could have also waited because if it was a Friday or a Thursday that you opened it and it hasn't developed, let's say it's been running for 2 days and it hasn't developed, you can either decide to close it at entry and just look again on Monday to not take the risk. Because what did you lose? Let's say you go out at zero. Okay, you wait for the weekend, you wait for Monday, and you just reopen it. At least you didn't take any risk. If it's been running for 4 days and it's still at entry point, it's not developing. Just get rid of it. Don't get married to a position. Get rid of the damn thing, find a different one. Clearly, it's not developing. Whatever it's waiting for something. Just go find something else. If it's halfway to the take profit, what I could do, well, if it's halfway to the take profit and my trailing stop hasn't activated yet, I'll move the stop loss to 0 at least by Friday. So at least on the Monday, I don't have to worry about it opening and hitting my stop loss instead before I wake up. So do make a few steps of security, but yeah, you can hold it over the weekend. There's no problem. But if you are 90 or 80% towards your take profit on a Friday, and you know that every Friday it either pulls back or increases in the position depending on what the gap closer, the swap traders do on that pair. Like your US dollar always starts selling off just before the closure. So what you want to do is, okay, well then if I have a buy, I know it's going to pull back by the end of the day because people are going to be closing the position. Don't get caught out. Beat them to the punch. Just go with the wave. We're not here to beat the market, guys. We do not beat the market. We're too small and insignificant. Even if you have $1 million account, you're a small fry. So let alone it's us with our simple $2,000 accounts. You don't matter at all. All of us combined matter. On your own, you don't. So you're not going to beat the market. If your mindset is, I'm going to beat the market, you already lost. We're here to ride the wave. So if you know everybody's going to be closing their positions on Friday, which most of them do, you're 80% towards your take profit. Take the money, have a good weekend. Hold it and wake up tomorrow morning on Monday morning. It's like, oh shit, I lost half my profit, and you close at an even lower point. Right? So hold over the weekend, yes, but depending on where it is. I hope that made sense with how I explained it. Speaking about stop loss, which could drain. Speaking about stop loss, which could drain account and start of trading. No, a stop loss should always be, like I said, like a percentage. So if you have a 90 pip stop loss, it should be 3% of your account, let's say. So when you open the trade, that is 3%. It can never drain your account. It starts draining your account when you don't set up your stop losses based on technicals and levels, like I showed you this webinar, where you put it. Now, if you want more specific, like really in depth on that, YouTube, go to Legacy FX channel. There's I need to think. Technical analysis series that I did. I think it is the second part, entry and exits, where I really go in depth on where you set up the stop loss and why in different scenarios and different time frames. That might help you understand a little bit better why it won't drain your account, because it's as part of risk management that prevents you from blowing up your account. All right, I hope that answers that question. Somebody asked, do you trade 0.01 lots? Well, not anymore, but yeah, I used to. That's how I started. I started with a simple account of $500, the fourth one. That I then grew. And then I added some money to it along the way. And then I just compounded on it without taking money out of the account and just let it grow. Do you use any indicators or only price action for entering a trader? No, I use indicators as well. It depends a little bit. But on the majors, I usually just use RSI, stochastic, MACD, and like a double or triple moving average, because these are all calculating things the same way. So they're all based on moving averages, but if they're all doing it slightly different. And the benefit of that is that one of them individually might say it's a buying moment and the signal line is crossed, but it could be a false signal. But if you have 4 different ones doing this similar calculation in a slightly different way, the chances of getting a false signal is significantly lower. So you combine that with your technicals, you combine that with your fundamentals, and you combine that with your price action, then the chances of you taking a trade that goes immediately against you is very low. It will still happen from time to time, but again, you're reducing the risk of it happening. You're increasing your chances of it not happening. But yeah, there's plenty of indicators that I've used. But yeah, RSI, stochastic, MACD, and moving averages are the easiest ones to learn, and they do the job for the majors and the minors. For commodities and other things, you're probably looking at volumes and Hicks and all that kind of stuff, but start with those. Okay, so Lenny asks, which time frame is more profitable, even with a small account and smaller lots? Generally, I never use the M's. I don't want to use the word for it, but it starts with M and it ends up on or on. Trading in minutes is really bad because the minute trades don't really adhere to the rules. I'm going to really do a trade throw. 1 second. Right? If you look at a minute changes its mind every minute. A week barely ever changes. It holds for like a year, the trend. So you want to find a frame that works for you. And an hour will allow you to trade small lot sizes and big lot sizes on the same execution, except the difference is with the smaller account, you're looking at trading within the hourly range. And with a bigger account, you're looking for executing on the hourly, but looking at the day and the week to see where you really want to go. So you could set up different stages, different take profits or partials. Okay, cool, I understand. Okay, perfect. I hope that answers your question, Thulani. So an hour, I would suggest. Hour, 30 minutes lowest. I usually struggle with predicting market bias. Don't listen to others. Don't listen to others. Look at how the charts have developed and just understand why is it selling, right? Understand the fundamental basic. Why is something selling? Because there are more sellers by volume than buyers. When it gets to a really low point, understand that sellers are going to start closing positions, making volume of buy become higher. This is why it is a self-fulfilling prophecy when things turn around at new lows. Because people don't know how long it's going to sell, so we're going to start closing it, which means that it's going to slow down, which triggers more people into closing it. I'm talking about retail traders, huh? Which creates it to stop and turn the other way around. Now, when it comes to outlooks on bigger picture, these are fundamental drivers. You really look at the big picture and just go like, look, they expect the euro to grow by 5% this year. They expect the dollar to grow by 8% this year. So what happens to euro US dollar? It's going to go down by 2% this year. It's that simple. How it's going to do over the year, it could be climbing 6% the first half of the year and then decline 8% in the second half of the year. Or do 3 up, 4 down, 3 up, 2 down. Like, the route there doesn't matter, but if you take point A in January and point B in December, something happened. This is how bigger picture trades. But also, like with structured nodes, a position is 6 years, not 6 hours. Right? So is there any other way I can? Nah, if you just do everything I did today, you shouldn't care about the bias all too much. That comes maybe later when you really start fine tuning a few things, but till then, you shouldn't care about it. All right, I hope that answers that question, Elias. Marius, you, oh no, well, client. Walter asked, can we do this again, or can I please have the recording? This is being recorded and it will be uploaded to YouTube probably next week somewhere. So you can rewatch it and pause it and rewind it as much as you want. And you should also all get the recording. But Legacy FX sends it, so, but you should get it. Zulani asks, what can I trade with a 4-hour time frame when I have $100 and what can be my lot size? No, you shouldn't. 4 hours, you'll often have stop losses of the apart Euro CHF because that's like watching paint dry. Any pair where you have somewhat of movement that you can actually make money, you'll have in the 4 hours, you'll quickly get to stop losses of 100 to 120 pips, which means that even at a single micro lot, you're exceeding 10% of your capital. If you have a smaller account, so 500 or lower, I usually advise you to just save up some money until you can put in 1,000. This is, and this is not against Legacy. I know you can open with smaller accounts, but honestly, from my experience, if you want to trade a portfolio, you want to trade like from 1,000. Now, let's say you muster up $500. Right, so put away $10 a month for a few years. You're already learning how to invest. But okay, let's say you can save up $20 a month. Right, 2 years, you'll have the account ready, you set it up, and well, then you're going to have your own head fighting against you because it took you so long to get the money and then you're going to be scared. But trade on an hour. And only pick the trades where it's in, let's say, a weekly downtrend, and when the hour is also at the top of the week where it's already confirmed that it wants to turn around, and then only take the most optimal entries in line with the big picture to have the highest probability of making a good trade that you can probably hold for a longer period of time to grow the account a little bit faster, to get over that $1,500 threshold in a year, maybe 2 years, and then you can start trading a little bit more often. It's a compounding thing, right, guys? If you trade with percentages, you start compounding. Now, it might not grow like much because you might think, okay, let's say my target is 30% by year one. $1,000 becomes 1,300. The year after that, 1,700. The year after that, 2,500-ish. But now you start already accelerating. For now, you go from 2,500 to 3.2 to 5.1. Help me out here, 7,000-ish. Right, think about a 10-year track. You will have turned your $500 or your $1,000 into like 11, 12K. There's no other investment where you can do that, and this is with doing just 30% a year. With smaller accounts, you're going to more often than not have like 120% when you start getting the hang of it. And then you start slowing back down when you get to a very big, an institutional account. Let's say you get to 100 grand. When you have 100,000, doing 30% a year is more than enough. That's $30,000 return on investment. You're not going to get that anywhere else, right? Real estate, stuff like that, completely different investment types. You have to think about it like investment, not like you're playing casino, because if you want to do that, it's called a casino. Go there, put everything on black or red, do that 3 times in a row. You might get lucky. You have a higher chance, 49.8% chance to the power of 3. There's a higher chance than forex if you do it that way. Do I open trades at market? Yeah. I barely ever use pending orders. Unless I know that the market is going to be at a pending order level where I know I'm not going to be there for it, or it might spike there because the market has been developing weirdly and I want to make sure to grab it when it gets to that point, I'll just set up the pending order anyway. But more than not, I'll just put alarms, then make sure I can get in front of my computer, double check, triple check, confirm everything, go through my flow chart of longs and shorts and exposure ratios, double check the lot sizes, double check the stop losses, double check price action, and then execute it. You might think that's a lot of work, but trust me, you'll get so fast at it, you'll do that, all of that in 5 minutes. And when your execution time frame is an hour, you have like 3 hours to make that decision before it actually starts moving. So don't worry about it. So yes, I open at market. Okay, if I butchered this name, please don't take it against me. Mosiua, thank you for your kind words. Wakar, I've seen signals provided by Legacy. What is the success rate? We are also learning the setups. Please send an email to webinars@legacyfx.com to request their performance papers to see what their success rate is on the Telegram and their and all signals provided. Don't ask them just the signals you have provided, because you allow them to just send the good ones. Tell them I want all signals provided in the last 3 months. And then you can just put in an Excel sheet and calculate the ratio, unless they already have that ready for you. Might be smart when you ask for information like that. Do you open at market or limit trade? We just did that one. Both, but mainly at market. Yes, thank you. You're welcome. When we get signals for buy or sell, should we do action on the same time, or should we look at the chart properly? Okay, first of all, I hate signals, but that's a personal thing. People always ask me to give them signals as well. Also, when I was working for brokers as retention agents, I hated signals. The reason for it is I rather have, my philosophy is I teach you how to fish. I'm not going to give you the fish. Learn how to fish. You can do it yourself. But if you get a signal, yes, always double check for yourself. Okay, they said on all these criteria, it's a buy and our expectation, blah, blah, blah. Great. Could be a great signal. Let me open up a chart. Let me take a look at it. And let me make up my own mind. Because in the end of the day, you are pressing the button. It is your money you're risking. You need to be behind the trade. Not because somebody else said, look at the signal. Look at it. They can be great pointers like, hey, this chart is doing something. We're thinking about this. Okay, well, let me check. Maybe I'll agree with that and then I'll take the trade. Thank you for the tip. But never do it blindly. Always double check. Mohammed, I don't know if the 50% discount is all on, still on. Check webinars@legacyfx.com. Just email them there, or just go to the website, guys. You can go to legacyfx.com and check for. I'm pretty sure discounts and stuff will be on their site. So Beyond asked a really good question, actually. So his question is, does history repeat itself in trading, or due to the situations, now it's different because of the war and COVID and inflation and all this stuff? It is different, but yes, history repeats itself. In other words, the only thing that changes because of these things, it might have a more volatile moment in the market, The patterns in which it moves will still be the same. They might be bigger, they might be smaller, and the prices that they happen at might be different. Inflation, and this is really good as a point, inflation for the euro is what, 3.2% or something per year. So if the dollar is an inflation of 2 and the euro is an inflation of 3, the percentage, the euro should be 1% stronger than the dollar over the year. So that means that next year you start at a new price level 1% higher than the previous. So the market shifts up a little bit. And then you get the correction at the end of the year. If the inflation is the other way around, it shifts down a little bit. What happens in between is those knee-jerk movements like what we saw here. Let me go back to the chart real fast. Week. When we go here, March, this is COVID. That's all COVID did. It was already selling. Then COVID March happened because this was all the run up to the whole COVID policies nonsense. COVID policies, nobody knew what the hell was happening. Then they made a decision. Market started recovering. Once it reached the previous level of June 2019, which it tried from there before, it just shot through it. And look, market just corrected itself all the way back to where it was before. And now it did the downtrend that it was going to do anyway. So it's just repeating this trend. So yes, markets repeat themselves. You might have knee-jerk reactions in the middle. These movements of volatility are our lifeblood, guys. If the market doesn't move, you can't make any money. Going in at 1 and going out at 1 equals 0, so you didn't make any money. Going in at 1 and going out at 100, you made a 99. Make sense? We want volatility. As scary as it is because it's a knife with two edges, volatility makes us happen, makes trades grow. And if trades grow faster, you will have more opportunities more often. If you look at Euro CHF, right, this is like watching paint dry. Like, what do you think the big candles are big? How big do you think a big candle is on a week? I'll show you. Don't be scared. It's a whole 300 points. Amazing. GBP, JPY used to do that in an hour. All right. Yeah. Sorry, I got a really thick throat. I just ordered some water. Wow. Oh, wait, I got something. Oh, that feels better. Okay. Now let's do the same thing on the euro US dollar. We'll take a similar candle. That one's 200. That's 200. Now we go back to Euro CHF. Let's see how often that happens there. That was an exceptionally large candle. Now let's see what the average candle is. 100 a week. 100 pips a week. So if you enter perfectly on a Monday, you'll have 100 pips by the end of Friday. 100, like this is great for practice, but you're not going to make any money on Euro CHF. But I tell people to practice it because it's very stable. It doesn't really move around a lot, and it's good for practice. So yeah. And it teaches you patience. Yeah, exactly. Can you give us a link to your YouTube channel? You know what? I should really start one YouTube channel at some point. Good point, Leon. Once I make one, I will. I mean, you can find one. If you just Google my name, I'm sure you'll be able to figure it out. I think I got one promo video I made on there at some point, like 8 years ago. I've been busy with webinars and other things. I was thinking about doing Twitch streams and stuff like that, just live trading and all that kind of stuff, but I never got around to it. But show your support. I might actually start doing it. Can you advise if there's any webinar for stochastic RSI, MACD, and RSI? Well, Sashi, exactly those three and 2-3 others I have covered. If you go to YouTube and you type in Legacy Effects, you will find a webinar called Indicators. I cover all of them, including setups and different uses in different time frames. Go give it a look. We'll give you all the questions you need to start with. There are more advanced things to do with it. I know that, but Legacy Effects on YouTube, you'll find a webinar called Indicators. That's the video you're looking for. Overbought, oversold, momentum indicator, same thing. When you understand how it calculates, what it calculates, you can use it. It's fine. But make sure it's not the only one you use. Use something else that goes with it, like an RSI. And then that will be for the overbought, oversold. And then you take something else that shows you momentum. Pick any of them. So you have one that has to confirm with the momentum part, and one has to confirm with the overbought, oversold moment. And if you have those three combined, then you have three different things that will tell you whether a yes or no. You can change the indicator's responsiveness by shifting around the delay. You can make it more and less jumpy. And you also have to understand the difference between exponential and linear, right? This is how you tweak it. It will never be perfect. An indicator is never perfect. An indicator uses historical data to predict current market position in comparison to that, right? I always use the comparison. If you have a glacier that's been around for 300 years and it gets hit by a meteor tomorrow, it turns into a bloody lake. You step out your door in the morning, you look at it and go like, well, the glacier's gone, it's a lake now. The indicator will still think, well, it's a glacier, but it's doing weird now for some reason. But it's a glacier. It should do this. This is also why trading robots all blow up eventually. Something shifts in the market, making a glacier turns into a lake, and all of a sudden everything goes upside down. And this is why you always need a human input. Like let's say you were trading a ruble, the Russian ruble. Indicators will just keep trading it like the war never happened because there's no input for war happened. You know, so you know that the market has changed. All right, so I hope that answers that question. I was just, we got a few more questions. Learn online trading course. Is there any online trading course or even books that you would recommend? I really need to get a list of recommended books for you guys to read. I keep thinking about that before webinars to write it down on the top of my head. The way money works is an important one to understand because it makes you understand why money needs to be the way it is. But I forgot the author again. Online trading course. Google me. I'm not gonna during the webinar legacy effects, go into detail. But Google is a great tool. Where can we learn how you use the indicators? Walter, the same thing. Go to Legacy FX. Go to YouTube. Type in Legacy FX. You'll get under the page, and then look for the webinar on indicators. I cover 5 of them there. I think they're the more basic ones, but it'll give you a good start. Yuri asks if I use Elliott wave analysis in my charts. Some of them I do, but the problem with Elliott wave is that it's really open to interpretation about which leg is the longest one and where's the leg actually starting and which is the repetitive wave. And like Elliott wave is generally not used by retail traders that much because of its open interpretation, and you can have different readings on the same thing. You're welcome, John. Good luck. Or yeah, prettige avond. So Elliott wave, it's good if you know what it is, but I wouldn't implement it in my trades because it's too open to interpretation. I did do a webinar on it, so if you want to go to YouTube again, Legacy Effects, there's actually a webinar where I cover Elliott wave. If you want to learn a basic start on how Elliott wave works. Forget about when the advanced part because that goes real deep. Okay, Marius. So Marius has like a preference. If you want to trade South African, that's fine. Legacy FX on Legacy FX, that's fine. But if it is, you also have a broker in South Africa, just purely on RAN. Just be careful because South African brokers are not exactly known for good regulation. I would recommend Legacy in that case. Well, actually, Legacy is a really good broker. Would recommend it anyway, but especially in that case. Is it possible to send a record? You all get the recording. Once this is closed, the recording should be sent out by Legacy FX to you. In any case, it will be uploaded to YouTube by somewhere next week. Sashi, thank you for the webinar. Good night. Thank you for your kind words and thank you for being here. Walter. General indicators give a late response. Okay, like I mentioned this earlier. You can tweak it a little bit and how responsive they are by setting them more to exponential, but making them more reactive creates them to give more false signals. You want to balance it out between a reactive one and a more passive one, so you don't get caught by false signals too often. And they have to align. Could you also advise whether and how volume can be used for identifying buying or selling opportunities? Learn at the indicator webinar I mentioned. The MACD uses volume, and I explain how the signal line on the volume is your telling point for going in and going out. Because guys, on top of everything we did today, when you combine it with something like that, you even fine tune it even more. Huh? So you have your price action, you have your technical analysis, your price action for confirmation, and then you also have your indicator giving you the exact moment, roughly. And then you just go in. Because at some point you need to understand like how many confirmations for what I want to do is going to be there. And at the same time, how many times do I need to be told, no, I'm not ready and I'm too stubborn and I still do it anyway. And then wonder why you lost the trade. Trade like a machine, think like a human. How can I know the market maker's entry? And is the liquidity of the market important in trading? Okay, this is an important one. How do I know the market maker's entry? Market makers have fixed strike dates that they execute trades, which is usually the Monday mornings. And then on top of that, it usually goes in combined with other things. You shouldn't worry too much about it. Honestly, you shouldn't. It's quarterly, it's monthly, it's certain fixed strike dates that they use through execution houses. And generally speaking, they just trade month and week view. They have nothing to do with the hourly. You're just going to see a big knee jerk there. And then it's going to balance itself out later with everybody counter trading and closing and whatever. Just if you see a big spike, just wait it out. When it comes to liquidity of the market, this comes down to what I said earlier is volatility. It is important once you have the balance that you can kind of chase trades, you look for where the market is moving. You look where there is liquidity in the market, where there's volume, where the money is moving, and that's where you want to trade, because that trade is going to be a lot faster in developing and finishing than any other trade. So it allows you to rotate through more trades more often while maintaining the same risk levels and everything else in your risk management setup. So you just rotate through more trades, but you have to grow into the balance in order to allow you to do that. Glenn, regarding the, yeah, they're good. I have a personal, I know they're good, but and thank you for your kind words. Oh wow, we made it to the bottom, guys. No, it's only a 2-hour webinar. Okay, I'll ask this. Any final questions anybody has? I'm glad you feel that way, Glenn. Okay, I just hear crickets at this point. So I'm going to go ahead and once again, for everybody that's still here, I want to thank you very much for staying with me. I appreciate your time. Um, and like I said, remember the survey that's usually sent at the end of this story. The webinar recording, you should get it sent, and otherwise check YouTube next week, Legacy FX channel. It should be uploaded there. And again, everybody, thank you for coming. And as always, have a great evening, day, or morning, wherever you may be. And for those that are trading, as always, trade safe, trade smart, and see you on the next webinar. Cheers.